Alpesh Patel has a background as a Financial Times columnist, an expert on Bloomberg TV, and a consultant for brokers all around the world. He's really a man that needs no introduction, but he's here today to talk about how brokers acquire clients, and it's not what you think. Let's give him a warm welcome to the stage.
Thank you. Thanks for that. Thank you for that kind intro. Part of that went live on TikTok. I tell you, you've achieved your pinnacle of your career when you've got a following of tens of thousands on TikTok. So what I wanted to talk about, over my 25 years of experience of working with a variety of brokers, is what's worked when they're acquiring clients. And I'm talking about the B2C end of things. So when CMC, Saxo, Intertrade, all of those are acquiring clients, what's worked, what hasn't, and it's not the kinds of things that you might think. So I'm going to share those insights with you. Okay? And like I said, it's built on about 20 years of experience of working with a variety of brokers. What I'm going to discuss is obviously the massive boom that we're seeing in terms of broker numbers, the background you're already familiar with, but more importantly, what works and what you didn't know about what works. And then right at the end, the bits you already know, the obvious stuff. I don't want to teach you the obvious stuff too much. So I really want to focus on that what works and you didn't know bit. My background, these have been past clients of mine. And for various reasons, usually because they want to acquire more clients. They want more customers. And it could be a variety of products. For life, it was when they were launching universal stock futures. And obviously for IG, you can imagine it was more to do with spread betting. For Goldman Sachs, it was covered warrants when they wanted more clients using covered warrants. Okay, and so on. And like I said, I've been doing this and in the industry for over 20 years. The fat bloke on the left is me, and the fat bloke on the right is me. But there's a 20-year gap in between the two. You know these figures already in terms of new brokerage accounts, and we've had a bit of a fall off. I think CMC had their results today. We've had a bit of a fall off in terms of the boom, but you're familiar with that. So what are the winners doing right? The ones who are getting it right, the ones who are making the most money, other than, of course, name recognition and spending patterns that they have. And why are some of the others not catching up? There's a boom going on. And if you're from one of the brokers which isn't growing at the rate as the market leaders, you may well be thinking, how come we're not participating in this as a brokerage? How come we're not filling our boots with retail clients the way so many of the others are? Again, I'm sure an image you've seen and you're familiar with in terms of the massive highs of retail clients. And as they come off their pelotons and their online trading accounts at the same time, maybe they were doing both things at the same time. Of course, it's slowing down a bit, but there'll probably be a plateau we'll stay at. Okay? I've written about this area. So again, just in terms of background and credentials, there's a whole bunch of books published by the Financial Times on online trading. I don't suggest you read them because they're somewhat dated now. But my background in this industry comes not just from working with the brokers, but also from having studied it very closely as well. And I've done the whole brand ambassador thing as well. And I know none of those pictures actually look like me, but it is me. And like I said, the demand continues. I'm not showing this to say that's the pinnacle of my career being on TikTok, but it's to say the massive demand. It's ridiculous. The demand through retail clients means they're willing to even listen on platforms like that to a middle-aged bloke like me talking about finance, which suggests that there's still a hell of a lot of growth to go for brokers to pick up more and more retail clients. And of course, as an industry, it's been good to me, and finance more generally, but online trading in particular in over those 20 years. I've no conflicts with you guys. Whatever area you're in 2004, I set up my hedge fund and private equity fund. We have no conflicts with what you do. So in telling you, I'm not from a brokerage. I no longer advising brokers, and I'm not a brand ambassador for any broker. So I've got no conflict with anything that I'm going to tell you It is just purely my observations over the last 20 years of working with brokers and working very closely with them. Okay, so that's a bit about the boom. You've seen the headlines like this, $1.4 billion windfall. Why are they doing it? Is it the fun part? What is it that, the likes of Robinhood and is it about the memes? Is it just because they're offering crypto? Is it because they had all these furlough payments? Is it because of Musk and moon rockets and YOLO and Wall Street bets? Obviously, that's got something to do with it. But I'm going to suggest there's a different reason why some brokers have won and others haven't. And it's sort of related a little bit to that article right in the middle where they've talked about financial nihilism, and you'll think, what the hell is that? Well, I'm going to touch upon that. Brokers a long time ago became very, very wealthy when they moved away from being like estate agents and matching buyers and sellers, which is what estate agents do, and take a little bit of a fee, and realizing that, heck, if 80 to 90% of our clients lose money, now it's sometimes 60% because the FCA requires you to post that number, and so it's getting a bit embarrassing to say 90% of clients lose money. What would be better is if they say what proportion of total losses versus total profits are, because that's probably closer to 10 to 1. For every pound somebody bets with a broker or CFD provider, it's probably £10 loss for every £1 that their clients make. But the FCA doesn't require that yet. You're no longer estate agents in the brokerage business. You decided to be the house, which obviously makes sense. If 80% of your clients lose money, why the hell would you be the doorman and say, listen, I get £1 every time somebody goes in and blows £100 or £1,000? You want to be the house. You win either way. And you have clever little algorithms to make sure that the spreads unwind, are widened and unwind the positions and net each other off, and you can do that. So, yeah, brokers are now the casino. And that's fine, perfectly legal, nothing wrong with casinos. I like casinos, I think they're great fun. But it made a lot more sense, and that's how CMC became a billion-dollar company, and some of the others which have floated, and IG, of course, because they were able to switch around. So what are you and what are you not? Well, you're not really angels, of course. Of course, you're providing a great service. But when you break it down, this notion of free trading, and you and I all know, and we're all institutional here, so we know that it isn't actually free, even if it's Robinhood and how it's portrayed. It gets sent off to hedge funds, and there's still an inherent cost to the end client. And that's fine. Why not? You're not there to be angels and provide a charity service. That's not what you're in the business of in any event. So we don't have a problem taking a bit of money off, and of course the FCA chase you and say, well, listen, 80% are losing money, that's a bit unfair. And these kind of, and I have no affiliation with SpreadX, these kind of numbers, of course, get the clients even more excited. And that's partly what it's about. Getting the client excited and over-optimistic within the bounds of the FCA's guidelines on financial marketing. So you can't go nuts, but when you show factual statements like this, you and I both know the clients looking at it are overestimating their skills, particularly because 90% of your clients are men, and men tend to overestimate their skills in most things in life. That's statistical, that's proven. So, despite the fact that for the professionals, and in my industry, in the hedge fund industry, we're left scratching our heads, let alone our colleagues are taken down by retail clients, because we know it's bloody complicated out there. You're still able to pull in the retail client who's going to bring down the guys who gave their entire life to building up their institution. Yet, you're able to get them through the door with the level of confidence that, yeah, I can beat the big boys. So what's going on? And these customers keep coming through the door. And of course, then you get this. This comes up on my Facebook page sometimes. You get numpties like that. They buy a few 100, screens cost about £100. They cost about £100, but they make you look really clever. So you get numpties like this advertising their services of how, again, they're going to turn you into a hedge fund manager, okay? The fact of the matter, as you know, is that study after study shows that the retail client's going to be on the losing end. So how do we overcome that massive hurdle? Because if you can crack that and get that last part of the market, which is cynical and believes it can't win, and it's a casino and they're gambling, if you can crack that market, you're laughing. I mean, forget the low-hanging fruit, which has already been taken up by the big boys spending gazillions on marketing. I mean, what's the customer acquisition cost? I think about 20 years ago, £5, you're laughing. Now, you're looking at about 50 to 200 pounds customer acquisition cost for a retail broker, and they'll be all right with that. They'll blow that on their Google ads and so on. But what if you could crack open the ones who might know, they won't have read the studies, but they might know, listen, I'm not going to become a trader. By the way, I should declare, the only conflict of interest I declare is I've been an expert witness in court when we've sued brokers. I know you're all angels as an industry, but when we've sued brokers, Raj sued, and I was the expert witness in his case, he sued MF Global, they're bust now, not his fault, they paid him 21 million. And then we went to, where else? Obviously, Vegas, the home of casinos, to celebrate with his winnings. But we know what's going on the inside of brokers, and they're able to get smart cookies like that and rip them off, and then they have to be sued. So, okay, what is happening? And they get sued by, well, that's tragic. So we know there's these headlines of losses, and every website has it. So how do you get over that hump? And hedge funds have no problem sharing strategies with people, but that's not what the retail clients are going to do. What is it they're going to do to get through the door? And that's the bit I want to tell you now, the bits you don't know. And in all my years of experience, whether it's, and I was looking at the financial reports of, like I say, CMC, it could have been IG, it could have been any broker, and they'll talk about the millions they're spending in technology and all the rest of it. Your ultimate aim, and I'm not talking about the morality of it or the ethics of it, but I'm just speaking from an entirely amoral perspective, is to build overconfidence. Now, the FCA probably doesn't want to hear you say that, but that's what you guys are doing. And if you're not doing it, within the boundaries of the law, that's what it is. It's building overconfidence. My job, on the other side, speaking to retail clients, is to tone down their overconfidence. But that's my problem, not yours. Whether it's news, auto charting, signals, alerts, newsletters, webinars, experts, articles, seminars, shove them with as much technology and information so they get this overconfidence. That's what it is. That's ultimately what it's been. About 18 years ago, that's from a slide of a talk I gave when I was lecturing on behavior and finance at Corpus Christi. Can more information lead to worse investment decisions? Yes. And the two economists who I relied on for that subsequently have gone on to win the Nobel Prize in Economics for their research. The tools you're using to build the overconfidence are exactly the tools which are going to cause your clients to lose, which is great news for you guys because you're the casino anyway. You want them to lose. You don't want to say that, but that's what you want if you're taking the other side of the bet, which most brokers do. Very few will say, oh, we're just straight to market, straight through processing, we don't take the other side of it. And they'll say, we'll be a new entrant. They're just competing on price. Won't last because the greed gets you in the end and think, why the hell are we leaving so much money on the table? Right? So what happens? It doesn't. I won't go into all the studies, but there's a hell of a lot of them out there that more information doesn't lead to better investment decision making. It leads to overconfidence, the thing you want. And the double whammy and the kicker which works in your favor is it also leads to more losses for the client. Now, my job on the other side is to point this out to the client, by the way. If anything, my conflict with you is that I'm on the retail side. I want the retail guys. Overconfidence leads to overtrading, increased cost, and poorer performance. The studies prove it. Overconfidence is boosted, of course, by a bull market. There's studies this morning, newspaper articles on exactly this. I think the CEO of Goldman Sachs said people are getting greedy. They think this is going to continue forever. Overconfident investors lower their expected utility by trading too much and too speculative. That's in the economic terms. So when the IT department says we've got this new great tool, in a way, that's a marketing spend. And when the annual report says, oh, we spend thousands on technology, that's why we're a great brokerage to help the client, it's actually not helping the client. Most people know that you're better off as a client trading less frequently rather than more, but you want them to trade more frequently. You want to be making sure you hit them with notifications on their cell phones every 5 seconds, just popping up. Before I came on, I had 3, one of which was Visa's down 5%. Now, that's not going to make me jump online and sell my Visa stock, but there's a hell of a lot of other people it will, because that information has bred some degree of overconfidence that they're first in, and it's going to make them take action. All under the guise of, oh, we're just helping you, we're just keeping you well-informed and educated. The two don't go hand in hand. Research was done with Forex traders. 8 groups of traders were given 5, 10, 20, and 40 pieces of information. And these were professional traders in banks. Their predictive powers did not improve as they were given more relevant information on what was happening in the macroeconomy. But their level of confidence in their predictiveness did. Now, thankfully, we live in an age where we're more cynical about experts than we've ever been, thankfully. But the great thing is, if you're an execution-only broker, you don't even have to pretend to be the expert giving the advice. That's the client you're making into an expert and overconfident that they're an expert. Experience is also a form of information, but do we learn from it? Apparently not. Again, studies on various markets have shown that people don't become more rational as they get more experience. In other words, it is more likely your client will lose all their money, and that's what will cause them to stop trading, than that they eventually get better and trade more. They think they're going to get better and trade more. Actually, they'll end up losing their money. And if they've got more than one account, which you know they tend to do, the race is on between, are you going to put your hand in their pocket first, or is the other guy? So you've got a race. You've got to make sure they run out of money with you first and build that overconfidence by giving them all these wonderful, whizzy, free tools. Like I said, I'm not making a moral judgment. I'm telling you what's happening in reality. And I've been, as I say, an expert witness in court. I've been an expert witness in court when one individual, most of you might not know this, if you go bankrupt through speculation, recklessness, it's a criminal offense. Not civil, it's criminal. And so this one chap, his lawyers had contacted me to ask me to be an expert witness to see if he'd been reckless or if he had a strategy when he went bankrupt as a result of him trading. So it is serious. There's another, there are lots of these experiments which have been done. The Economist did one. 4 finance ministers, 4 Oxford economics students, 4 chairmen of industry, and 4 dustmen. They were asked the average inflation figure in 12 months. Okay? And guess what? Yeah, the finance ministers, the Oxford economics students didn't win. The dustmen did. And you might say, well, yeah, because they're living in the bloody real world. Of course they did. That's not the only example. Financial Times in 2004 ran a competition for market experts to predict the FTSE in a 12-month period. And just to mix things up, they threw in there the editor's cat. So you had all this information, and they threw in the cat. And the cat had a load of numbers to select. The cat, out of, I think it was about 20 people, the cat came 14th, which isn't bad. 13th, within a whisker, was Neil Woodford. I kid you not, okay? I'm pleased to say, in my overconfidence, I came top and was within 0.5%. But was that luck? Or was it skill? Well, I'm a man, so I'm going to say skill, obviously, in my overconfidence. But that's your job. Get those whizzy tools. Anybody comes to you, wants to sell you another tool out here and says, look, we can do this, we can, just think marketing. And think, how much overconfidence will this give our end users? Not how useful will it be, how much overconfidence will it give our end users? Now, personally, I'm on their side, but I do believe in online trading. I think it's worthy if they don't fall into the trap of overconfidence. Okay, and you know this one, I'm sure you know it. 95% of British drivers believe they're better than average. Are there any Italian men here? There was another study done with Italian men. I'm not going to go into the details of confidence levels and what the question was. You can probably work it out. But they're just as overconfident as British drivers, male drivers are. God bless them. Okay, so what's effectively going on? They believe they're more in control than they actually are, which is great for you guys. But that's the final frontier. It's not the guy with the furlough payment, because, yeah, you know, you want to get more return on your Google ad spend. It's the person who's still cynical in a room, the person who still thinks, nah, you guys, I don't trust you guys. You brokers are no good. Those people with the deep pockets, you getting overconfidence out of them? Now, I don't do that. I'm not a broker. And like I said, I'm not sure it's particularly moral, but that's the business. Brokers don't couch it in those terms. So I want you, when you walk around, to think in those terms. Will this generate more confidence in my end users? The most cynical. Because my God, if you can get the most cynical client, you've got 99% of the rest of the market which aren't as cynical, just waiting to open an account with you. That's what it is. Okay? And again, lots and lots of research which has been done. Oh, I'm out of time. You know this already. Men tend to be more overconfident than women, so I'm afraid you probably want more male clients because they're going to be more overconfident. They're going to lose the money sooner with you. They're going to fill your pockets sooner than women, who tend to be better at making profits and keeping money from you. Again, I'm sure you know the studies on all of this as well. And I guess it's this quote: "It's not what a man don't know that makes him a fool, but what he does know, that ain't so." And that's not changed. Last night, somebody pointed out to me that, and I'll end with this, that the box, you know the box in cricket which protects the ball from hitting a man's testicles, basically. The box was invented in something like 1874. You know when the cricket helmet was invented? About 100 years later. It took men 100 years to work out that they might want to protect their brains as well as their genitals. Trust me, that level of overconfidence, that's the trick. That's what you're after. I won't go through all of this, but this is the stuff you already know. What makes the difference? Yeah, sure. Commission-free, good customer support, usability, qualifications of the broker, regulator, market access. When we asked the public what it is, they're not going to say anybody who makes me feel overconfident. They're going to say I want all of these things: low fees, research, blah de blah de blah, usability. These are the things you already know. That's why I'm not going to go through it in much detail. Okay, these are the things that you need to overcome. You know this. This is just bread and butter. And the companies out there will try and sell you on, will reduce the friction so you get more clients because we'll improve your customer service, improve your profit margins, et cetera, et cetera. In actual fact, and when brokers were asked which are the best, retail clients were asked which are the best brokers, these were some of the names that came up. Okay. And for the US, these were some of them. So if you want to see what works, well, just have a look at what they're doing. But that's the conventional stuff. That's the boring stuff of what you already know. The overconfidence part nobody talks about. But there is a serious part to all of this, which is this. And this was done by Bruin Dolphin. And it's financial stress. And I'm afraid our industry does add to it. Whether it's my end, the hedge fund end, or whether it's the brokerage end, I'm afraid we do tend to add to it. So when you're doing the whole overconfidence building, just remember there is a consequence to all of that. Thank you very much. Hopefully you found some of that at some point useful. Thank you.